Welcome back. The dollar hitting its lowest level against other currencies in 2 months this morning after the weak GDP report yesterday. We are also seeing some encouraging numbers out of Europe, perhaps painting a better picture for the emerging markets. Joining us now is our wealth management series guest. Joseph Tanious is from Bessemer Trust, investment strategist with more than $100 billion under management. Good to see you, sir. Thanks so much for joining us.
Thank you for having me.
What are the implications of the dollar reversing here? We're looking at the dollar down for 5 straight days. Big move yesterday, up on the euro and down on the dollar.
Yeah. Well, I think generally speaking, it's no surprise economic growth here in the U.S. has weakened a little bit. And of course, momentum overseas has picked up. And I think if you take a look at Europe, you've got GDP numbers, you've got manufacturing. A lot of that data, the high frequency economic data, has started to pick up. And so ultimately what you've seen is a bit of an unwinding of that dollar strength. But I wouldn't necessarily think that, the dollar strength is over. I think a lot of these factors that had a negative impact on economic growth here in the U.S. are transitory. And as growth starts to pick up, I suspect that the U.S. dollar will strengthen once again.
So you think that we go back up. So what is the investment play around the dollar reversing and actually continuing that uptrend that we've seen in place now for a year and a half?
I think you first have to consider what it means for other countries and other currencies. And in particular, Maria, it has a big impact on emerging market currencies. Think about commodities. Commodities, of course, are priced in U.S. dollars. And so as the U.S. dollar strengthens, that's going to put downward pressure on some of the commodity exporters. You also have to consider as interest rates here in the U.S. begin to rise, at some point, once the Fed raises interest rates, of course, that's going to put more upward pressure on the U.S. dollar, and that may put some downward pressure on emerging market currencies. So the first thing you got to do, I think, is think broadly about how you're investing across the globe in emerging markets in particular.
Well, what do you want to do, though, for emerging markets? We've been waiting for the emerging markets to break out now for a couple of years, and whether it's due to where interest rates are in the U.S. or due to an absolute slowdown from China to a number of other emerging markets, we are just not seeing an investment opportunity here. Is there?
Yeah, I think you hit the nail on the head. There hasn't been a whole lot of an investment opportunity. And again, with the prospects of a strengthening dollar and rising interest rates, it's difficult to get excited about the group as a whole. We keep thinking back to the taper tantrum we had not just too long ago. And while I don't necessarily think it'll be as severe as the Fed raises interest rates here in the U.S., so much because a lot of this is already priced into the markets, I think it's going to be a challenging time. Not only do you think about assets reflating across the emerging markets, but you have to consider, of course, their currencies. And as their currencies weaken, is it really worth the investment? I think you want to be positioned in the emerging markets, but you need to be careful. You want to look for those countries that are commodity importers that stand to benefit from the weak commodity prices. And you want to look at the manufacturing exporters, some of these countries that run current account surpluses and stand to benefit from a rebound in growth from their trading partners in Europe and the U.S. as that part of the world starts to accelerate.
Well, if you're going to start, predicting where the dollar and interest rates are going to be in the U.S. In order to get a sense of what happens to the emerging markets, you have to go back to the core fundamental story in the U.S. So we just got the Chicago PMI out. That is for the month of April. It came in at a level of 52.3 versus an expectation of 46.3. So it was better than expected on the PMI for Chicago PMI. And this is one day after a GDP report that was basically squat. It was effectively zero, up 0.2%. So what is the trajectory of the U.S. economy right now from your standpoint?
I think U.S. economic growth is likely to accelerate. I mean, what you just pointed out right now, looking at first quarter GDP coming in at 0.2%, just incredibly disappointing. And then taking a look at manufacturing, a regional manufacturing survey, which tends to be a leading indicator, there's a very clear difference. And I think what that's telling us is economic growth here in the U.S. is likely to accelerate. We know some of the reasons why U.S. economic growth was so weak. Of course, you had the impact from lower oil prices, you had a strengthening dollar, but you also had an unusually cold winter. And interestingly enough, when we study weather patterns, we find that really bad weather doesn't necessarily cancel spending outright. It simply delays it. And so I think what you're going to see is over the coming weeks and the coming months, an acceleration of economic growth here in the U.S. really driven by pent-up demand.
All right, we will leave it there. Joe, good to have you on the program today. Thanks so much.
Thank you, Maria.
Joseph Tanious is Bessemer Trust investment strategist.